If you spend enough time staring at a 1-minute or 5-minute chart, the market starts to look like pure chaos. Red and green candles flash, spike, and reverse without a clear pattern. Many traders get caught in this environment, reacting to minor price swings, only to watch the market snap back and hit their stop loss. It's a cycle of chasing volatility while fighting for scraps in the middle of the noise. But by focusing so closely on the movement of a single tree, you end up missing the direction of the forest. The broader macro trend is often moving in the opposite direction of your intraday focus. Large financial institutions and their algorithms don't operate on these 5-minute fluctuations. They move capital across major structural levels, leaving a readable trail of liquidity and order flow. To see those footprints and cut through the daily noise, you need a specific framework. This is where ICT monthly and weekly profiles come in. To stop absorbing retail-level losses, you have to change the scale at which you view the market. Zoom out to a 1-month chart, and the noise disappears. We extract 5 points from the previous month: open, high, low, close, and the midpoint, or equilibrium. Algorithms use these as reference points, pulling current price upward toward the previous high. We can establish a macro bias by looking at where the previous period closed. A close near the high indicates an expansion toward higher prices, while a close near the low suggests the bears are in control. Plotting these arrays removes the guesswork. You're left with an evidence-based framework that defines the high probability direction for the current period. To understand value, we isolate the midpoint, the algorithmic equilibrium. Everything above is the premium zone, where assets are expensive and institutions sell. The area below is the discount zone, considered cheap territory where institutions accumulate buy orders. This creates an absolute rule for your analysis: avoid buying in a premium zone. Instead, wait for the price to pull back into a discount before looking for an entry. Adopting this valuation model helps you avoid buying late into exhausted breakouts and aligns your trades with institutional value. Zooming back to the 15-minute chart, price action looks volatile, but our macro boundaries and discount zone act as our guide. We wait for price to drop into the discount territory and strike a key support level, like the previous week's low. Reaching this macro level isn't an automatic buy signal. It's an area of interest where we look for a specific micro trigger reacting off that macro line, like a market structure shift or a fair value gap forming as price moves away. Once the trigger forms, we define the trade. The stop loss goes below the micro setup, while the target is the macro liquidity at equilibrium or the previous month's high. This connects the high-level roadmap to the low-level execution. The macro profile provides the location, and the micro setup provides the timing. By using these profiles to filter your entries, you align your trades with the same levels used by institutional participants. Trade with institutional precision. Enjoy 0.0 pip spreads. Start trading with FXNX today.